Regulation should safeguard stability, empower responsible risk-taking, and accelerate inclusive growth today, tomorrow, and for generations to come. Good morning, everyone. A case for DFI regulations. I want to welcome all of you to this breakfast. And first of all, allow me to acknowledge, starting off with our DG, Public Investments from the National Treasury, DG Lawrence Kibet. We are also honored to have the Chairman of Kenya Revenue Authority, a good friend of KDC, and a promoter of why institutions need to be regulated, Mr. Nderito Moreithi. We equally have CEOs from various local and multilateral DFIs. We have Edward Klassen, head of EIB Global East Africa region. Maybe you'd stand and wave. Then we have Angela Muga, country manager, East African Development Bank. Then we also have Nelson Kwamini, CEO, KIE. Then we have Jean. Allow me, Jean, not to mention your second name. From Popako, the regional director. Most welcome. Then, of course, we have our critical partners from the World Bank, starting off with Ben Musuku, senior financial sector specialist. Karibu sana. We have Leah Kiwara, also a senior financial specialist to the World Bank. We have Olga Oyer, a consultant. And then we have Johnston Oletiti, KMRC. So allow me to welcome all of you to this. On behalf of KDC, it gives me a great pleasure to welcome you all to this morning's engagement on a subject that is increasingly becoming central to Kenya's economic future, the evolution and regulation of DFIs in Kenya. I wish to express my sincere appreciation to the DG, Public Investments. We are really honored to have you here, DG. And I think for us as DFIs, it's important because we have most of the stakeholders in the room. And a lot of us are owned by the National Treasury and fall under DG Kibet. And so DG, we are seeking as DFIs to have more transparency, better oversight in terms of what we do. So we are really honored to have you here. Equally, Chairman KRA, Nderito Moreithi, you also have a lot of expertise in terms of this sector of financing, having worked to the World Bank before. And so we also felt it's imperative to get your perspective in terms of what we are trying to achieve as DFIs. So the quality and diversity of representation in this room from government regulators, DFIs, and development partners demonstrates that the future of development finance is no longer a sectoral issue, it is now a national economic priority. So ladies and gentlemen, DFIs, we occupy a very unique space in our economy. We are purely not commercial entities, nor are we ordinary public entities. Our role is fundamentally catalytic. And so DFIs exist to intervene where markets alone are unable to sufficiently support long-term national priorities. They provide financing where risks are high, capital tenors are long, returns may take time to materialize, and broader economic benefits extend beyond immediate commitment. So in many respects, DFIs finance the future before actually the markets have actually identified or recognized the opportunity. So, distinguished guests, ladies and gentlemen, despite this systemic importance, DFIs in Kenya currently operate within a dedicated legal and regulatory framework. Well, there exists no regulatory framework that governs us. And so a case that we are presenting today, why we need to be regulated and how we should be regulated. And so, and we are anchoring this on 4 pillars. A case that we're presenting today. So DFIs, the case for a dedicated DFI regulatory framework rests on the following 4 pillars. First is governance and accountability. A dedicated DFI regulatory framework would complement existing governance and oversight mechanisms by establishing common principles and standards tailored to the development finance sectors. So in Kenya, we currently have 4 DFIs. I know we're also expecting the CEO from AFC. And so we want to standardize how we carry out our operations, how we are regulated in terms of capital adequacy, in terms of various reporting structures. And also, I believe, even from an operational perspective, one of the main challenges we found is actually being able to deal with our bad book. The current regulations are actually quite strenuous. And so also this gives us an opportunity where once we are oversighted, it can also be easy for us to be able to handle some of these bad debts. Second would be financial soundness and capital adequacy. A lot of these DFIs, and KDC is a classic example of how government sought to resolve the issue of capital by bringing together 3 DFIs that were carrying out various mandates and developing one cross-sector DFI, which is Kenya Development Corporation. So a regulatory framework would then set prudential standards tailored to DFI business model, including capital adequacy, ratios, liquidity requirements, and provisioning standards, ensuring DFIs remain financially sound and capable of weathering credit cycles. So the issues of us constantly requiring the National Treasury to recapitalize us, to give us budgets through, to allocate us capital through budgets, I think would be able to resolve this, as we'd be able to now raise money from the markets. Third would be to access to institutional capital, domestic and institutional investors, pension funds, insurance companies, sovereign wealth funds. I'm sure DG Kibet would tell us here today that success for him would be one day for any of these DFIs to either be able to float. I know KDC has been challenged to either float an industrial bond or a green bond, but for us to do this, we must start building confidence within the markets. Therefore, a case for regulation. Fourth, coordination and mandate clarity. So we all exist to serve various sectors. Mandates and geographical focus. Mandate overlap and promoting coordination and ensuring that public resources directed through DFIs achieve maximum development impact. So ladies and gentlemen, it's against this backdrop that KDC has taken the initiative to propose this development of a regulatory framework that seeks to address this regulatory gap. The proposed regulatory framework is expected to provide a comprehensive legal and regulatory framework for development finance institutions in Kenya, drawing from best practice across comparable jurisdictions in Africa and globally. So what do we expect today? Today we're going to have conversations, and we're just setting stage in terms of DFI regulations. What we are hoping to be able to achieve is a shared understanding among stakeholders on the need for DFI regulations and its implications for Kenya development's finance sector, to build a consensus on the need for a DFI regulatory framework in Kenya, then structured feedback on the proposed regulatory framework and an agreed roadmap on advancing the DFI regulatory framework. So DG Kibet, KDC already has a draft DFI bill that was done once the merger happened. So what we are trying to do is to get our other DFI partners on board so that the regulation cuts across not just for KDC, but equally for other DFIs, because we all face the same challenges and all are looking to achieve the same objectives. So we are working with various partners, and DG, this one is going to be sponsored by the National Treasury. So it is good that you're also present so that you're able to also give us the weight that is required to be able to push this and also to bring on board my colleagues. I know regulation is, and that's why I started off with the statement that it shouldn't be so painful, but actually I think it will also enable us and empower us as development financial institutions to build confidence with our partners who are in the room. I know Leah took a bet on KDC when we were seeking for funding as from World Bank. But otherwise, I think we've proven ourselves. But if we were regulated, I think it would make it much easier for the development partners to be able to forward more capital to these DFIs. Allow me to recognize the presence of my board chair, Honorable Sakwa Bunyasi. Chairman, welcome. We are just starting. So allow me once again to warmly welcome all participants and to thank all our stakeholders and partners for their continued collaboration and commitment to strengthening Kenya's development finance sector. So thank you all. Let's have engaging conversations today. It's a very brief meeting, but I believe the outcome of this will set stage and roll out development of this DFI bill. And once we have all stakeholders on board, I'm sure we'll see our DFIs doing better and having more economic impact to the economy. Thank you, everyone.
Thank you, DG, for setting the context for today's engagement. So as we consider the future of regulation for DFIs in Kenya, it's important that we also hear from perspectives from experts and also from our partners from other jurisdictions who have had experience in regulating of DFIs. So it's now my pleasure to welcome Honorable Nderitu to share his perspectives on regulation of DFIs.
Honorable Bunyasi Sakwa Bunyasi, Chair of KDC, to prop up my own CV, we were together in the 10th Parliament with the Chairman. So let's appreciate the Chairman of KDC. My colleague, Lawrence Kibet, the Director General for Public Investments, DG of KDC, colleagues, ladies and gentlemen, good morning. I think the reason I was asked to say a few things is historical, because I cut my teeth as a professional a few years ago, firstly as a consultant and later on in IFC, trying to finance small business in Kenya and in the region. Later still, I spent a bit of time trying to stimulate capital markets to see if, if capital markets could be the source of the nature of capital that small business require. Together with others, including my friend Githuku Mwangi, who I see at the back there, and we were doing stuff around things like credit bureaus, credit scoring, trying to stimulate bond markets. In most of those things, we were only moderately successful in getting progress. So, because of that, I did get a little bit of experience in this space about what kind of capital do African SMEs, and I suppose SMEs anywhere, what kind of capital do small businesses in Kenya require? And I think we can all agree it is longer term in nature, as DG Nora has said. It's a patient type of capital. Because if you look at any small manufacturing entity, the payback period cannot be 2 or 3 years. It's unlikely. And so commercial banks, because of the nature of their funding, may not be really suited to provide the kind of capital that is required. Welcome, MD of E. So it cannot be that this kind of capital will come from commercial banks, at least not them acting by themselves. Some additional work has to be done. And I think you can all agree. By the way, in those days when I first started as a young professional, our friends at the European Investment Bank had a program that was called Enterprise, and they were financing, again, in fact, they financed a lot of horticulture, John. So that nature of capital is what, in my view, DFIs step up to do. And I think even in the industrial countries, you will find a strong DFI that is able to do certain things in order perhaps to crowd in, to bring, to persuade, to assist commercial banks to step up. If I had been able to persuade my colleague, Director Kibet, and our bosses, frankly, we would have put in a bit more capital into the DFIs. I myself had this ambition that this year we could put, I don't know, 60 billion, 70 billion into DFIs. One of my favorites is now moribund. We used to be able to finance tiny, tiny industrial or manufacturing or things. It was called SEFCO. So it's parked somewhere. It was a small enterprise finance company of Kenya. It's parked somewhere in the development bank as a moribund institution. And I would have thought we'd put 3-4 billion and get it going so that we can finance small manufacturing entities that require 5 million shillings, 10 million shillings. I know our colleagues, KIE, are in the house. I would have thought that we would, I don't know, 10 billion maybe. But look, I'm a humble tax collector. I don't make policy. So don't take these things too seriously. I already told you, had I been able to persuade my colleague, the DG, and our bosses, that's what I would have been trying to persuade them. Because if you look at this strategy of the county aggregation and the KIPES, the question is, the SMEs that are going to process agricultural produce and what have you in those KIPES, who will finance them and what nature of finance do they require? And quite likely it is players like the Kenya Industrial Estates who can do that. And I know that Leah and I, I think before she discovered I was a pep, Leah and I spent some time on KJET, and we were thinking about how this could happen. And of course, you go on in the right like that. By the time you're at KDC, maybe you are thinking about 40, 50 billion intervention in order to move us to the place. Why all of this? And I'm going to stop shortly. Mainly because, as I said already, commercial banks are ill-suited because of the nature of capital they have. Reasonably short-term deposits. So they may not be able to make a loan for 10 years. Albeit one or two that have big balance sheets are able to do so. But for the most part, they're not able, commercial banks can't do so. In addition, we already are in a unique circumstance of fiscal imbalance, which forces government into the credit market all too often. And we also exist as small open economies in a circumstance where the structure of monetary policy, we generally have high interest rates because of the strength of our currencies, because of issues of inflation and so on. So all these things suggest a specialist team of institutions that could resolve getting credit, particularly to manufacturing And I hope you all know that we haven't been doing well. If you look at contribution of manufacturing to GDP, that has been declining over time, suggesting again the need for specialist intervention. All of this in order for me to say, I agree and I support regulation of DFIs. However, a caveat that we cannot regulate DFIs in the same way as commercial banks. Because after all, the very purpose of DFIs is to do things that commercial banks cannot do. So we cannot regulate them using the same mindset or the same toolbox. And by the way, we did, some years ago, some of our DFIs were encouraged to begin taking deposits, and they soon found they could not be DFIs by taking, short-term deposits as the way they mobilized capital. So I agree, and therefore I think it's a wonderful thing, and thank you to our colleagues in the World Bank and others who are supporting this initiative so that we can create the right environment. One of the reasons why regulation might be useful is a very obvious one that involves me and the fellows who do the work that I do, which is that you must shield these institutions from the vagaries of the political economy. And regulation is one safe way to do so that these institutions can perform their work without too much political interference. Ladies and gentlemen, I thank you very much indeed for listening. Derito Mureithi, tax collector. Thank you.
And indeed for reiterating positions that to be unique regulation shape the future of these institutions. And therefore, to also hear from our development partners and for perspectives from other jurisdictions, it's now my pleasure to welcome Ms. Leah Kiwara from the World Bank.
Thank you so much. Good morning, everybody. Honorable Sakor, Honorable Nderitos, DG Kibet, and all CEOs present, and allow me to observe all calls. We're not used to observing these many protocols, but I'm quite pleased because this morning I realized I have literally worked with almost everybody here, and I am financing a lot of people. If I was to mention these two tables, I think you would find AFC, MD, KIE, we are coming, not yet, KMRC, and KDC. Huge financiers of yourselves, and of course the National Treasury is our main implementing agency. So today I really like the remarks that Honorable Ndirito has made today, because really they touch on the remarks I was going to make today as a development partner. So I cannot stress enough the role that DFIs play in economic growth, job creation, structural transformation of countries. But as I was doing my research very quickly, I realized despite the financial sector in Kenya contributing more than 10% of GDP, actually DFIs in Kenya actually hold less than 1% of total financial sector assets. Now that's a very big gap for the remarks that Honorable Ndirito just made here. And that shows you there's a big financing gap, because the question is not the role of these DFIs, it must be that the DFIs don't have enough capital. And I think when the CEOs speak, they'll point onto this big demand that they're not able to meet. So this is a critical topic that we're having today, because for DFIs to play this critical role in development of these countries, they must have a financial sound framework, and this comes from regulation. So we are quite pleased as the World Bank to finally see this conversation happening, and we are more pleased that this is not happening on silos. We are happy that the three DFIs are coming together to have one uniform DFI bill. So I'll just highlight a few international best practices that we see from other markets that ideally should be underpinned in a DFI bill. And most of them have been mentioned earlier in the remarks that the DG and Honorable Ndirito made. So some of those are: one, if you're to have a DFI bill that works, and the one thing that I have realized working for the last 8 years with the bank in Kenya is Kenya is a very unique case that you cannot bring US standards to Kenya or bring Malaysian standards to Kenya. Kenya needs to bring its own standards while borrowing from best practices. And number one is to highlight the need for a risk-based prudential regulation. I think you mentioned, Honorable Ndirito, that banks cannot have the same level of prudential regulation standards in Kenya. And why is that? For example, if you look at Basel principles, if you require certain capital structures to be held by DFIs, you'd be further crippling them. So I want to point to the DFIs here to look at the Malaysian case. We've worked with the Malaysian government and the Malaysian Central Bank to set up the Malaysian Development Financial Institutions Act. It's quite a good one because what it does, it aligns their Basel standards and other prudential regulations to meet DFI-specific mandates. So, for example, they're able to cap some of your capital requirements and liquidity requirements. Number two, best practice is you need a regulatory oversight that is independent. In most markets, we find the central bank is the best placed body to regulate DFIs, simply because the business of DFIs is very closely aligned to that of commercial banks. And we always say that DFIs should not receive exemption. So as much as we are aligning to the mandate of DFIs, we do not want to have exemptions provided to DFIs that would distort the market. Simply because as your DFIs grow, it is highly likely that they could also cause shocks in the market. Thirdly, I also want to reinforce the aspect of this mandate clarity. Now, most regulators, and this is where your DFI bill would need to emphasize on this, as much as your regulators come to regulate this sector, it's important for this DFI mandate to be highlighted. DFIs, ideally, you should not be crowding out the private sector. DFIs are here to resolve market failures. And central banks have to apply that lens when they're doing your supervision and regulation so that ideally they enforce that practice. I cannot stress enough, as DG said earlier, on strong corporate governance, and more so because most DFIs in Africa, as we all know, get a lot of interference from political classes. So the need for strong corporate governance is something that ideally would need to come out very clearly in your DFI bill. I also would like to highlight the point of transparency and disclosure requirements. I think this is something we've been working very well with KDC on enhancing your ESG practices. I think that's one area you find the commercial banks and other financial sector players are doing a little bit better on. So having that level of transparency with regards to your ESG practices, ensuring that you're aligning to the IFRS standards is quite important. Now, as I was doing my analysis of the contribution of DFIs in the economy, I realized, and as you know, job creation is the biggest topic for us as the World Bank, and I imagine as well in our country in Kenya. I realized I could not even trace the impact that you DFIs are having on jobs. And I think you are having a large impact on jobs. So this is also a good opportunity as you get regulated and supervised that you reinforce this whole issue of development impact monitoring. This is one way that the central banks can help you to measure your impact downstream on the ground. Now, finally, to finalize the main point and the reason why I'm always so enthusiastic about regulation of DFIs, it's to highlight the issue I raised earlier. DFIs in Kenya, I highlight again, form less than 1% of assets in Kenya in a financial sector that is very strong. That means you guys are not able to pull in enough capital. Why? Because in Kenya, you have a very tight fiscal space. My macro guys will tell you, ideally, the government would not be able to continue giving you concessional financing as DFIs. So where will you get this financing? It's from mobilizing private capital. And I think that's really the biggest thing is a well-regulated DFI is the best instrument for crowding in financing. I think someone mentioned earlier the role of DFIs in rolling out bonds, green bonds. We would like to see that more in Kenya. And I think Kenya over other African countries we work in is quite ready and to take up this kind of engagements. I'm quite pleased to also see the level of innovation. We are working with KDC to set up an equity fund which has already been registered. That's another instrument of private capital mobilization. And ideally what we found, I think the chairman here will tell you, as we went for roadshows, most of the sovereign wealth funds kept on asking the question, is KDC regulated? And that ideally impedes your ability for other sovereign wealth funds and DFIs to crowd in financing to you. For example, my sister company, IFC, would tell you they would find it very hard to crowd in financing to the DFIs in Kenya, simply because you're not regulated. So this whole issue of crowding in private capital ideally can only come in if you regulate your markets. And I think you have very good examples in Brazil and South Africa that I would highlight that are doing very well, the DFIs there in terms of PCM, and being able to also measure this private capital mobilization. So lastly, I won't speak too much. I did not come here to give any lecture, but just to highlight for you some attributes that you should have in your mind as you think through this DFI bill. And I stress more that a DFI bill would need to align on the as the other speakers have talked about. Allow me to call my colleague, Ben Musuku, to also add his remarks on this. Thank you. Ben, over to you.
Really, I don't know what to say after four speakers have come before. But maybe just to say maybe a couple of points from sort of a World Bank perspective that maybe Leah didn't mention. I think when it comes to this topic as the World Bank, if this was the same year 1980 or 1990, I don't think we'd be in the room. Or even as an institution, we've come quite a long way in terms of thinking about DFIs, government-backed financial institutions. And so it's quite gratifying to see a forum like this thinking through in terms of how do you approach this agenda in a modern world, given what we know, given what the history is. And this is not just a uniquely Kenyan history with this institution, but it's a global history. And as Leah said, there are examples, very successful DFIs that have been transformative in terms of mobilizing capital and deploying that capital to its most productive use in economies. And so this is really a great for Kenya and for us to be in this as partner. Just to pick up on what had mentioned earlier, he talked about years back, but again, why up on that? Because with DFIs, I think having a perspective, I think we need to judge success over a long period. I'm Zambian. The first time I came to Kenya was 1997. That's almost, I'm not aging myself. I can tell you the Kenya I found in 1997, whatever sector you talk about, is certainly different from the Kenya in 2026. So some of those early investments are slowly beginning to pay off. And also what the DG had mentioned, she called them pillars. I would stress that to me they sound more like foundational layers. So the same speech, just put it in landscape. I think governance, transparency, all of these points, I think that was said, is foundational, is crucial to the business that you're doing. And I think it's also important not to lose sight of why do you need this regulation? Because it's very easy to think of these things as simple technical solutions, but they are not. They are really foundational pillars. And why do you want to do this? Because there's not enough money that's going to come from the treasury, from the budget, to fund the kind of development, industrialization that Kenya needs. But there's enough money in the markets. So you need these pillars to really provide that credibility that markets need for you to be able to attract the capital that is needed to fund that development agenda. The governor did say that DFIs cannot be regulated like commercial banks, correct? But the corollary of that is that DFIs cannot do business like commercial banks, because if you act like a commercial bank, then you need to be regulated like a commercial bank. So that's really where the delta is in this ability to mobilize money from the capital markets. The World Bank is kind of a DFI as well. And so for us being here, it's a natural affinity for this kind of conversation. We leverage our shareholders, we leverage our balance sheet to be able to raise capital on capital markets through the IBRD window, and then be able to translate, because we're AAA rated, we're able to translate that moderate borrowing costs from capital markets to our clients, the various governments that we work with. And that's an approach that DFIs, with this sort of initiative, you could actually also look to in terms of how you actually mobilize that capital. Because the issue here is really a funding gap, as Leah had stressed. So it's working within the existing constraints, whether they are fiscal or structural, and to be able to provide that financing that is there. So I really didn't have much to say, but really just to emphasize that, and let's have a 30-year perspective to what this development is, and hopefully we meet again in 2056. Thank you.
Thank you, Leah and Ben, for your remarks. Now, ladies and gentlemen, the journey of transforming DFIs and to get a robust development finance ecosystem requires strong leadership and strategic oversight. So it's now my pleasure to welcome the Chairman of the Board of Directors of Kenya Development Corporation, Honorable Sakwa Bunyasi, who will in turn welcome our chief guest, DG Lawrence Kibet. Thank you, Chair.
Good morning, everybody. It's my great pleasure to be here today. I came in running a little late. I underestimated how long it would take me to get here, but that's Nairobi. Thanks very much, Governor Nderitu. It's always good to hear you and to see you. Tax collectors are extremely important. All from the days, all the way from the days of Zakayo, so it's not new. And all colleagues who are here, DG Kibet, and all the other dignitaries that have spoken, and I see some are sitting in the audience. My name is Sakwa Bunyasi. I'm the chair of KDC board. I have had a rather long experience with DFIs. Actually, probably it's a lifetime of some of the people present here. And I've seen things change. Kenya, for instance, the Kenya of the mid-60s when I left university, and the Kenya of today is completely different. Thanks, for example, to institutions like AFC, preceded by Land Bank, at the time we got independence, and what they did in terms of being able to finance the agrarian economy, which was at that time almost all that we had, and the bold decision to set up institutions like ICDC that provided hope at the time of how to get the Africans into the new economy that had now become the economy of independent Kenya. And what they did, from basics of transfer of assets from some groups to other groups and so on, but also small scale manufacturing, processing, and that kind of thing. It had many bold attempts, many failures, but also successes. In fact, some of what is now, what became the Kenya industrial sector, manufacturing, is all embedded in ICDC. So they do play a role. So the comments that were made that you need a long-term perspective to get a sense of the impact of DFI is really important. It's not a 5-year thing, it's not a 10-year thing. 2, we are now operating in an atmosphere in this new century where now we have learned through first-hand experience that the development models of the world are not what we thought they were. When I was a student, we would look at, as we looked at Europe and America, we said that's the way to go. The models looked like what it ought to be. You looked at Russia and China as countries who are following models that are failed models, are likely to be failed models. Little did we understand at the time when the Cold War ended, that even the Soviets, the Chinese, were very sophisticated. We now know the Chinese model, which is a public sector model with a mix of private enterprise salting, also goes a long way. One thing that personally I've observed, and I worked on China for some years, is the bold steps China took to eliminate the subsistence component of their economies. And they had many sections that were not integrated in the rest of the national economy. That opened up space, that opened up demand, and as a result of trying to get all of that in to contribute to the national economy, DFIs played a very strong role. The DFI I worked with most in China at the time was the ABC, Agricultural Bank of China. Back in the mid-80s, ABC had about 1.5 million members of staff. We used to have a title in the World Bank called Division Chiefs. They had about 40,000 division chiefs. Everything was on a huge scale. Then what has happened? Because the national ethos was to try and get everybody to participate in production, contribute to food, energy security, and so on and so forth, everybody was brought on board. Here we are operating in this country, even in the commercial sector, 80% we are told is informal. And when they say informal in Kenya, it means it's almost not useful, which is not true. That's where most people are. At what pace are we working to transform those informals to formals, subsistence to commercial, even if it is small commercial? Then we create an atmosphere of a competitive environment in which the DFIs can now then play a role in mobilizing resources, in applying those resources, and so on. And KDC, we have very few institutions in Kenya, actually, when you think about it. There's room for a lot more. And our colleagues from the World Bank, as they interact with our government, should bring the best of what they see from other places. And there are many other things happening. In countries like Turkey, for example, in countries like Thailand, for example, bring to bear so that there is more of the same. We will get a lot of competition among these institutions, and by so doing, we'll strengthen institutions and expand the outreach. And I'm sure they can do that. The model that we have used for a long time in relations between Leah, sorry, where is Leah sitting? Yeah, I'll say this. These are old colleagues, and I don't want to say something completely out of line because I'm not there now. That we had a top-down model between the World Bank and developing countries. We defined what they needed to do. We came and made them look like theirs. We get them to write a request to come to us, and then we finally mobilized globally to get people to prepare programs for them and so on and so forth. But now we have gone a long way. The other day we had, I don't remember what the two-day event we had at KICC. What did we call it? In which we were, what was that? Say it again? Next Frontier. Yes, Next Frontier, yes. And I was there, I sat together with the Governor Ndiritu, and we addressed some of the sessions. And the nature of energy that was in that hall was huge. Kenyans want to move. They have ideas. So that DFIs and any institutions working with them simply ought to marshal broadly. We have capacity that we didn't have before. We are not taking it in. We are not yet succeeding to take it in. And therefore, my thinking is this, that as we think about regulation, it must not include control. And I've been battling to see how I can put this across while differentiating the two. The regulatory framework gives you a broad boundary which does not have walls. It's like open air, two air masses meeting, they intermingle a bit. But control is when you don't want anything to move unless you say yes. So DG Kibet, my prayer is that in this process, in which we are trying to get a regulatory framework, which of course indeed you can't let people double into this kind of public space without those broad frameworks, must not include control. We must not be able to have to come to hire a financial analyst or designate that person by a different title. That's how we work. That's the environment we are in. That even in recruitment we found that in defining who we want to recruit, what kind of profile we want to have, we still have to go back and get permission. We can't operate like that. The central bank regulates commercial banks, but they do not control what they do on a day-to-day basis. I just pray so that our senior managers in the Treasury, particularly, are also entrepreneurs in their own way. They will say, let them go ahead and do what you have to do. Just don't exceed the following boundaries, perhaps very broad boundaries. We even have something like, for someone to qualify for, I don't know what job it is, they must have had 4 years, not 4 years, 4 weeks of a course or something like that. 4-week management course or something like that. Who offers that now? People go for 2 days, 3 days, seminars, a week here and so forth. So let us regulate, but let us not control. Finally, I want just to say that for us in KDC, we are struggling to find ways in which we are going to, in which our kind of business grows in this economy, and that our development partners are also flexible enough to work with us to get a more open way of getting things done. And as I said, those remarks about Treasury by name, I am conscious that many changes have been made, the restructuring us, and they're also moving in that direction. And if you move this, if you move the scale up a bit, you have a president who is our biggest PR master, so that it's now a challenge to follow through and grasp from the things that they're pushing in the new financial architecture that we have got, in the infusion of the new frontiers like green finance and so on, and other aspects that need to be done, so that we help Kenya and help ourselves to become even more dynamic than we are now. I am very, very hopeful indeed. I know that KDC has capacity now, but yet much greater potential, and that journey I think they're going to walk very, very effectively. The other day I was, and as I conclude, I was given 5 minutes. I knew I would extend them a bit. I've done maybe 10. I'm just finishing shortly. I was talking to a lady from EBRD that is setting up office in Nairobi, and it was clear that they are very hopeful about what Kenya can do. Kenyans sometimes get shy. Kenyans get mixed up with the political perspectives. You know, we have a very dynamic and noisy political environment, and that sometimes slows down people. And now with AI, you get all manner of stuff that comes out there that's not quite correct. But Kenyans can go a long way. You find us in many parts of the world now, all over. So we are there picking ideas, bringing them home. And as we bring them home, some of the places that are going to house them will be KDC and KDC types. We should not be shy to do that. The future is bright, the way I see it. Let us just go for it. You see that the strains of development in Africa are showing. I see what's happening in South Africa. I think it's very important to mention that. That kind of thing, when the economies are unable to absorb the unemployed or to meet their goals, and how people can begin to react, they are going to force a contraction on South Africa. There's no doubt about that. I can't see how they're going to get out of that without succeeding to stem that kind of thing. Here we are in Kenya. We must grow. We must absorb. We'll absorb others from around Africa. We'll absorb our own diaspora, and it's us, the people, that are going to grow this economy. I want to thank you very much indeed for sitting together with us, taking your time out to come and sit together with us to begin to brainstorm. It's a continuing process of brainstorming on which way to go. And I know my CEO is here. The young lady, you saw her here. That's the new Kenya, you see? And that's the new Africa. And I think we are right there. So we are going to work together. my colleague from AFC. AFC was one of my early employers and so on. So I have a long history of our development process, particularly back from the Land Bank and so on. Thanks everybody for coming. Let us make this short session that we shall have today a highly productive one, and let us continue to have more of the same. DG Kibet, thank you very much for being here. I'm sorry I mentioned you by name, but I truly believe that you are sitting at a point that you'll help to make a difference. You'll make or break this process, and it's all now before you to see what to do. To become an entrepreneur and allow us to bubble under you as we grow this economy. Thank you very much indeed. I am a politician also, so I should have remembered that. It's my distinct pleasure to welcome DG Kibet, Director General in the Treasury. These are the people who make things happen in this country. And I'm very glad that you took your time to be present. Thank you very much indeed.
Thank you very much. Thank you very much, Chairman, Honorable Bunyasi, the Chairman of KDC, Madam Nora Ratemo, the DG of KDC, my good friend, Derito Mureithi, the Chair of KRA. And of course, it's important to also recognize important partners that have made a difference in this journey. We have VIB in the room, we have the World Bank, the IFC. I'm told we also have Probaco. We have my friend Oltetia here from KMRC. So largely, good morning, ladies and gentlemen. Thank you very much. So it's indeed a pleasure to be here this morning. Honored to represent Honorable Mbadi, the Cabinet Secretary to the Treasury, who was supposed to be here this morning. So first, of course, the first call of duty for me is to confirm the Minister's commitment that in terms of the journey that we're traveling, that this journey has the full blessings and support of the National Treasury. Why is this important for us, especially at the National Treasury? This is important for us for two major reasons. One of them is the DFIs will play a second-tier role in terms of what we are now doing, in terms of what we are terming as the next phase of transformation of Kenya. As many of you would know, some months back, the government of Kenya promulgated a new law that is the National Infrastructure Fund. So largely, the NIF will play the key national role in terms of transformation. And it will largely be looking at four major objectives. So one of them is that we want to scale up the level of putting up catalytic infrastructure in the country, things like our port, the airport, some of the major roads and highways that provide the necessary linkages. So energy generation and distribution will also be very key. We are now doing about 3,000 installed capacity. For us to be able to transform in the kind of scale that we require, we will need to triple that to at least minimum of 10,000 megawatts. And that's why the National Infrastructure Fund becomes very critical in terms of providing that scalability in terms of putting up this infrastructure. And we've put in place mechanisms to be able to do that, where we will really not be dependent on other forms of capital, but we have been able to generate our own capital. So far, the fund already has the first about $800 million generated from the privatization of Kenya Pipeline Company. In the next few weeks, once a few matters within the judiciary are sorted out, it will be getting in another about $1.6 billion. So our objective is to be able to push this to about $3 billion. And once we have that, then we will now then be able to attract other forms of investments as we now get down to work. The second bit in terms of what we also want to do in that space is, of course, to be able to attract the non-traditional forms of capital in, so that for every shilling that you put in, we think we should be able to attract between 8 and 10. And the third objective is to mitigate the over-reliance on debt in terms of putting in especially commercially viable infrastructure. And the last bit is for us as a country to also be able to build our capacity in terms of being able to develop, being able to implement large-scale infrastructure. And we don't even have to build this capacity just as government, but we are also going to take advantage of DFIs, especially where Kenya is a member, to be able to build this much-needed capacity. And we're working with a number of partners, the IFC, the AFC West of Lagos, the Afri-Eximbank, and a number of other partners. So largely that is what we're looking at in that frontage. But as we do that at that large scale, so what happens now in terms of taking this all the way to the grassroots? So we will need to develop very strong DFIs to then be able to complement this larger national goal. And this is important because for the DFIs, then largely here what you're looking at in terms of mobilization and application of this capital. We've seen, in 2023, we've just come in from a number of shocks. Or over the last 5 years, largely, Kenya has experienced the adverse effects of external shocks. One, of course, from the security challenges that we've seen that happen miles away from us, but we've seen the devastating effects that they bring to our economy. What we're seeing in the Middle East now, we've just come from the war in Eastern Europe. Before that, we had the COVID-19 in 2020. We've seen the climatic shocks because I think largely between 2021 and 2023, we've also faced serious climatic shocks. So what are we saying? So then we really needed the DFIs for us to then be able to build the resilience in our economy. And what are we looking at in terms of even building this resilience? So we've looked at a number of sectors. So one of them, largely, it's good, I'm with my chairman here, Nderitu Mureithi. So one of them is, say, agricultural transformation, for example. Agriculture today forms about 24-25% of GDP in Kenya, but its contribution on revenue perspective is only 2%. So it leaves a lot to be desired. And where is the disconnect? So the disconnect largely is because of the value addition chains, that we've really not invested sufficiently in value addition. So these is the areas where our DFIs, KIE, AFC, KDC should really now take lead for us to now be able to develop this kind of enterprises so that we can have these small-scale manufacturing companies. How do we invest in them? How do we enhance efficiency within that space? So that is one area that we're looking at in terms of building resilience in the economy. The other aspect is, of course, we all know that we face a serious challenge of unemployment in Kenya. And this is also the other aspect that this will really be able to help us be able to mitigate. The other front is, of course, broadening the revenue base as well, because if we build resilience in this, especially the MSME space, then it will largely be able to help us be able to catapult our ability to be able to broaden the revenue space. So we really see where these should sit in. And to also drive these kind of initiatives, the chairman, Honorable Bunyasi, talked about, let's regulate, but let's try as much as possible to remove controls. And you are aware, Chairman, that the National Treasury on the other part as well, to be able to drive this and make sure that we have a proper governance scheme within, especially our commercially set institutions. We have also promulgated a law some months back, what they call the Government-Owned Enterprise Act. And here was to make sure that this aspect that people don't like, basically that this aspect that brings a lot of inefficiency, called control, is done away with. So in the past, I'm sure, on Friday. Yeah? So, and we're doing away with this kind of matter because, you see, boards can even change every Friday. So the issue of certainty is even not there. The issue of transparency is not there. So what has the GOE Act brought in place? It's brought in place a transparent way of putting in proper governance in those institutions. And over the last 3 weeks, there's been a national advertisement out there because now the legal regime is that we've set up an independent panel that will now recruit board members for all the 65 commercial enterprises owned by government, which will now be independent from the National Treasury. And after that, of course, the boards which are recruited will also be independent, will have their own, will basically be able to set their agenda, where we will only be able to regulate, but then you will not be able to, we remove the aspect of control. The issue of hiring CEOs, doing all these other things, will be matters that will then be decided at board levels based on the larger frameworks that have already been provided. And so far, I think I will even dare say, the governance frame that has been put in place for running and managing government-owned enterprises are even of higher standards than even the private sector or even the listed companies. It is much easier to be a director in Safaricom today than to be a director even in a company like KDC, as we speak today, if the law remains as it is. For example, if you have been in the political space, what the chairman calls a PEP, yeah? So you will have to cool off for a period of over 5 years before you come in to sit in these commercial enterprises. If I retire from the treasury tomorrow, I will need a cooling off period of the same period of 5 years. The standards are really high to make sure that we allow these institutions to be able to thrive. Beyond that, we've also set very progressive performance measures for these institutions to make sure that, as we call them, for profit making, they actually are set up, and the infrastructure that has been put in place will allow them to actually make profits. So that's the reason why we're not here by accident. So we are here with a clear intention that we want to reform. And I remember when we appeared in some of the public participation forums, when we were putting in the government-owned enterprise bill, some CEOs, and I think I can even see a few in the room, told us bluntly that, are you sure you are not on academic exercise? Will this bill see the light of day? Because it's so progressive that we don't think it will see the light of day. How will you appear in parliament and tell parliamentarians that, if you lose your seat, you can't sit in these institutions unless you have a cooling period of 5 years? Will this bill see the light of day? And we are excited that, those very bold reforms have seen the light of day. And I think transformation will be much welcomed in this space. So, Chairman, I think now your fears are allayed. So I think largely in the room. So, of course, as we take, as we work through this particular process, especially with the partners that we have in the room. So let's have a very meaningful engagement that will help us really be able to make sure that we achieve the kind of objectives that we have set in terms of the role that these institutions are going to play. And there are a number of lessons. We don't have to reinvent the wheel. We've seen what an institution like KMRC, for example, has been able to do over a very short period, including even being able to go to the capital markets and be able to successfully raise capital in that particular space. These are the kind of things that we will be looking at. Because one of the reasons why, as you said, DFIs should really be able to help us, especially in areas where the normal markets not have failed, but cannot provide the appropriate tools to be able to use. Some of those small businesses can go to capital markets, can fit in the banking sector. So we really have to provide the appropriate tools that will allow us to be able to speak to them and make sure that we're able to address the kind of requirements that they need. And I'm also proud, even as I stand here, because I am also largely, practically, a product of the DFI. Yeah. So when my mother quit a teaching job some 50 years back, she ended up setting up a business which is still thriving up to today, using a loan from KIE, or basically once she started off her business, along the way, with a loan from the Kenya Industrial Estates, she was then able to expand and be able to build a very thriving enterprise. So largely, so you're standing in from that level of confidence, knowing that when we do it right, it shall work. So I think with those few remarks, ladies and gentlemen, it's my distinguished honor to say we now have the process moving forward. We at the Treasury will be at hand to be able to provide the necessary support that will be required. We will remain open-minded to make sure that, we really get it right. There is no proper rule book to this, so we will be willing to listen and be able to make sure that, the right steer is provided for us to succeed. Ladies and gentlemen, thank you.
Thank you, DG Lawrence Kibet, for your inspiring keynote address and for reaffirming government's commitment to continue strengthening DFIs in Kenya. So, ladies and gentlemen, we are approaching the end of the program, but we just have two more critical sessions. We'll now invite John to just give us a brief presentation about the case for DFI regulation in Kenya. It's going to take less than 5 minutes, and then we'll now go into the critical component of this session, which is to hear feedback from our participants and guests in the room, and then thereafter we shall build consensus on how we're going to proceed moving forward. So please bear with us. We intend to close in the next 10 minutes. John?
Okay, so the Director General, Public Investment Portfolio Management, Lawrence Kibet, Honorable Nderito, the chairman of KDC and the board members present, and the CEOs from other institutions, our development partners, distinguished guests, good morning. My role here was to simply make a presentation on a case for regulation of DFIs, but I would say, following the presentations that have preceded this, I think 60% of my work has been done, and I believe all of us are convinced of two things. One, that DFIs in Kenya still have a critical role to play. And number two, we have identified a gap that despite their strategic role, there is a gap in form of regulation. So my presentation, this was the outline, which I'll move very fast because much of it has been explained. I would wish to spend a bit of time. I will just highlight some of the regulatory gaps and challenges that we have. I will also speak more to what Leah talked about on the comparative regulatory models that are there. So I'll try and see what, just give some kind of pros and cons on what can work for us. I'll speak on the effective, tenets of effective regulatory system before we can discuss on the next steps. Here, I think we have already addressed, but I think for us, the key message here to note is that all these institutions that were established there, clearly at that point they had a role, but we also appreciate that over the years there were challenges that happened, and we'll come to some of those challenges that led to either declining balance sheets, some of them even converted. For example, I'm sure some of you have never heard of an institute called DFCK. DFCK actually is the current Development Bank of Kenya. It had actually to convert to a commercial bank along the way. The other institution, of course, some of them were merged to be what we are calling KDC. The others are still operating independently. But we are saying that they had a role to play, but I think the message for us here as key stakeholders is that for DFI, we must be in a position to evolve and adapt if our relevance and impact, if we are going to continue to have impact. The financing gap is still there, and I think Leah also mentioned about the gap compared to the market. Actually, in absolute, if you look at the figures, looking at the total portfolio of the DFI's loan portfolio is actually less than 60 billion. If you compare that to the commercial banks at around 4.6 trillion, it'll actually tell you the gap. It goes back to the challenges in financing, being able to access financing. The question to ask, do we still need DFIs even as of today? I think that question has been answered in the affirmative, that indeed we still require DFIs if we are to move to the next level as a nation. And of course, looking at the emerging challenges that we face as a nation, DFIs still have to play a critical role. Honorable Muredi talked about the issue of patient capital. That is still a requirement because of the challenges that we have, the commercial banks, which are very short-term and risk-averse. If you support the government priority vision, like the better agenda, the Vision 2030, we are now talking about the Singapore journey. DFIs still have a critical role to play in terms of crowding in private capital. And of course, in the period of crisis, like we saw during the COVID crisis, DFIs actually came in because if you look at there were stimulus packages that were rolled out across the country. You will not expect that from commercial bank. And even as in the future, we expect to, even as we face the issue of the climate crisis and building climate resilience, we expect DFIs to still play a critical role around that. And they're saying that despite their strategic role, they're still not regulated. If you look at all the key financial sector players, all of them are regulated there, from commercial banks to the digital credit providers, all of them, and those are the regulators. But DFIs are not regulated. So you look at this, this is now the map of the regulatory for the financial structure, regulatory structure for the financial sector. All the key sector players, all of them are regulated, but DFIs are not there. And these are the gaps. And of course, it means that the current legislation that we have, and of course we acknowledge that the GOE Act actually is very transformative. but still it's still not able to address the modern prudential governance challenges. And for DFI specifically, I think from the governance perspective, I think it will actually transform the whole public sector. But we still need more, especially on the DFI area, or especially on the prudential issue, matters that need to be addressed. Of course, this lack of regulation has created that fragmentation, inconsistent oversight. So each DFI is on its own. I think AFC is still under an act of parliament. Now KDC has moved to a different framework. And that's what you're saying, that there is need then to have a regulation to provide that certainty. I will not want to go to the other challenges, but I would like to tie this, because some of these challenges then we need to tie it to what the proposed bill need to address. Issues of capitalization, because you're saying the reason why we have had this challenge, and of course it goes back to the time of inception. Most of these DFIs at the point of establishment, they were actually established as mostly for lending, not actually without capacity to raise funds for long term. So they relied mostly on government financing, or mostly injection from support from other development partners. But they were not in a capacity, they are not in a position to actually go out there in the private market actually to bring in capital. And one of the areas that then we are seeing here is that by having the DFIs regulated, it actually is still confidence on other partners that even you're able to attract that blended finance, so that as governments comes in, you're able to attract other private investors so these are the other challenges, the high NPLs. I think that's known. Some of it is a legacy issue dating back to many years, weak governance. I think this has been addressed. If we are to actually go with what is in the GOE Act, or perhaps mirror the same, this will actually then address the issue of governance and political interference, the mandate overlap, limited coordination. Again, so these are the challenges. We have DFIs doing several things. And of course, the merger and the consolidation of KDC has helped sort that. I understand there's still more discussion about consolidating the other DFIs. So that will go towards consolidating and strengthening our DFIs. This discussion is actually not new. It actually is something that started way back in 2013. Actually, there was a paper that was presented by CBK, proposal where actually they proposed regulation of DFIs. But the good thing from that discussion is that even at that point, CBK already recognized that there was a need for differentiated supervision, that the same framework for commercial bank cannot work for DFIs. So at that point, the discussion was, can we have a different framework for DFIs, but they need to be regulated. The other piece of the reform was following the recommendation of the task force on the parastatal reform, again the same year in 2013. It made a raft of recommendation, but specifically for DFIs, it actually also proposed regulation and, of course, consolidation. Actually, that's how KDC came to be, following the consolidation of the three former DFI, ICDC, IDB, and TFC. So that was very transformative, but there are still things that need to be done, especially on the regulatory improvement. So we are saying that this the consolidation removed the duplication, because we are saying there were so many DFIs doing different things. So there is that now enhanced efficiency by having all the DFIs, but there are still those regulatory gaps. The GOE Act, I think the DG has mentioned that in terms of the governance issue. But also the other important bit it did is actually to bring all the DFIs under one piece of legislation. So previously we had KDC under the Companies Act, AFC under an Act of Parliament. We had also KIA under different platforms. So all GOEs now are under the are supposed to move to the Companies Act. Even the ones that were established under an Act of Parliament, the expectation is that all of us will be able to operate under the Companies Act. So at least that streamlines it sort of now there's uniformity in terms of how the legal framework under which the DFIs operate. There's also another piece of legislation. Actually, last year, or I think in 2024, there were some amendments to the CBK Act that tried now to extend their regulatory power over what they are calling non-deposit taking credit providers. These are basically what were the digital lenders, but they expanded that now to cover all non-deposit taking credit providers. But looking at the scope of that, it actually will cover most of the DFIs here because it only excludes either government or the county government or anyone else who is regulated. So you're not regulated. It means basically then you're actually supposed to fall under the non-deposit credit regulations. So these are still draft, although the Act is already amended to actually give CBK powers to actually over the non-deposit taking credit providers. So I think the challenge is for DFIs to move very fast because if we don't, we might find ourselves being captured under this regulation, which are not fit. Ideally, what we had in mind was more for the digital channels. Those arrangements for buy now, pay later, the informal Shylocks that operate in that field. So that's what was intended. But somehow it ended up bringing DFIs because all of them are deposit taking and they're offering credit. So there was no exception for DFIs. So I think the sooner then that DFIs are able to make sure that we are regulated because the only exemption is any other institution that is regulated. So I think then that's a motivation for us to ensure we actually develop a framework that is actually fit for purpose. Otherwise, we might find ourselves being regulated together with other digital channels. I would not want to spend, I think our DG mentioned this in terms of the 4 pillars and why we actually need this from physical risks. All DFIs here, either the funds that we're using are actually public funds, whether from government or from whether borrowed, because we are also guaranteed by government. So anything that happens there, it's actually it's a risk to the public, and those are the fiscal risks. That's why you need proper regulation. The governance, I think that has already been addressed. The unlocking of new capital pool, I think that's the key for us, because as DFI, for us to move to the next level, where you're able to actually go out there and open up, other sources of unlock, new sources of financing. This is the confidence that we need to give, and I think the good example there is from KMRC, which from start they were able to attract not only the new shareholders who were able to put in money, but all along you can see they have been able to raise funds, because I think one of the comfort that these investors are able to get that we are dealing with a regulated entity, because I understand they are regulated by the CBK as a special category. So I think this case has already been made on why we need this regulation. I will not want to go to the details, but in a highlight, this is actually some of the examples. Leah mentioned about the example for Malaysia, which is a very good example that we can look at, because where you're looking at having a dedicated DFI Act plus Central Bank of Kenya. South Africa is actually more or less like what we have. For example, AFC now, they're actually under an Act of Parliament with oversight through the Treasury and DFI. So we can't quite say they're actually regulated. It's more of self-regulation, oversight by the government through the PFM Act and of course through reporting to the ministry. Germany, I think AFW is more or less of another hybrid where they have a special law for the DFIs with also some kind of prudential oversight. India, again, that's another hybrid between Treasury and Central Bank. Malaysia, I think we'll come to that, looking at that. But basically, from here, we can actually see 3 models. So we have a situation where it's central bank led, where you're either supervised by the central bank, or number 2, you can create your own specialized supervisory board where it's separate from the central bank, or you can have both, a hybrid where you have like the central bank part of it, but also still reporting to the government through the National Treasury. I think for us then, looking at what will work for us, I think for me this session is actually one of the things that we need to agree is which model do we think will work for us as the DFIs in Kenya. Should we go with the CBK regulation where we are placed under a CBK regulation? I think that's similar to what KMRC, I think they created some regulations under CBK that actually then govern that sector. So the issue here is that the advantage will be that already they have strong prudential oversight because they have been doing this for many years, various sectors. So there's no time to build that capacity. So the risk is that they might impose bank-like, because you are saying that we need a very differentiated framework. So the risk there is that they may impose bank-like requirements, which might affect our development lending, and of course, higher compliance costs, and of course, the key risk there is also the mission drift toward commercial banking. So That's the danger if we are fully to go under central bank regulation. What about can we then consider dedicated DFI regulators? This is where you just establish a very specialized regulator specifically for DFIs. Of course, the advantage with that is that you're able to develop a tailored regulatory framework with a special expertise on DFIs, which then will bring in proportionate standards so that you're able to balance both mandates as a public institution, as a DFI, and of course the need to ensure that you're also sustainable and profitable. Of course, the disadvantage is that there will be high establishment and operation costs because you're starting from scratch, from even building capacity, and of course, duplication of existing supervisory function. If there's another body, for instance, CBK, or even like CMA also could be part of it, that if we are duplicating already what another regulator is doing, then there will be an element of duplication. And of course, this will require building capacity, both for the regulator and also for the industry. So there will be a learning curve towards that. So the hybrid model, here we are looking at where we have the central bank as well as national treasury, government oversight. Basically then leveraging on existing supervisory structure from central bank, national treasury. That has always been there under PFM Act. And of course, this also, I think, from the other models that we looked at, is actually the most common approach internationally. The risk there being potential overlap of responsibilities. You're not, when you have reporting to various, whether to CBK, to National Treasury, there could be conflicting priorities, and that would require then strong coordination. The last one is actually what we have right now, and I think we all have agreed that self-regulation, where we are just left on our own, and a number of the DFIs locally have been have adopted the DFI regulations, just more of self-evaluation, but I think that's where we are trying to move. So I think the discussion for us is, do we go purely under central bank? Do we establish a specialized supervisory board for DFIs? Or do we go for a hybrid model? And this is how a hybrid will look like. So we'll have a DFI Act already that will define the governance standards, the mandates, and reporting obligation. So CBK will then handle the prudential supervision and financial stability oversight. We have the National Treasury then as under the PFM to oversee development policy, alignment, and capitalization policy. The GOE framework, because I think we still need to tie it up. So we are not saying that we need to be excluded, considering the kind of transformative provisions that it has. We are saying that GOE framework can still remain, that then will support the governance oversight, so that the whole process of board appointment, which the DG said, has even set the bar higher than even the private sector, even for other listed companies, so that can still remain. So here we are looking at leveraging the CBK capacity that's already there, and of course the existing GOE framework. So I think that's an issue that we can discuss here and see which model do we need can work for us. As for instance, somebody suggested is instead of CBK, can we still have CMA, that because it's already handled, because our key issue is raising funds. I think we want to go out there and raise funds, and that's where CMA comes in strongly. Will that help address that bit of regulation, even as we look at the hybrid model? So I think that's an issue then that we should be able to discuss today and agree on the way forward. But whichever model then that we adopt, these are some of the key things that we need to look out for. One, I think, has already been said, starting by Honorable Murezi, is that we must recognize that DFIs are fundamentally different from ordinary commercial financial institutions. So the framework that has worked for commercial banks cannot work for DFIs. I think all of us agree on that. So we'll need a tailored system, a framework that is specifically suited to the mandate of DFIs, fully differentiating it from commercial bank. This will then balance the commercial discipline with the development flexibility and public accountability. So if you look at even the GOE Act, again, it is pushing more on profitability and sustainability. But on the other hand, we are also a development institution. So you need to balance all this. I know it provides for public service obligation. So we'll need then a framework that is able to balance commercial viability, development, flexibility, but we're also accountable and also sustainable. So that framework needs to be able to address that. Of course, there need to be clear responsibilities for the supervisor and even powers to address non-compliance and even having adequate. I think Leah also mentioned that they need to have proper independence and of course they need to have what we call, they need to have teeth to actually enforce what they have. They are not putting somebody there just for optics to actually say that you have a supervisor, but they should actually have the capacity to even impose penalties for non-compliance. I think that's the expectation. Of course, there is oversight on the capital adequacy. I think those are the prudential financial requirements that we're saying we need to be observed, the risk management and sustainability. But also most importantly is that the focus need to be on better regulation, not overbearing. I think just chairman called it control. I think there need to be that balance because it is not about more regulation. Sometimes I think there is always a danger to seek that by regulating more, you make it better. I think it's just how do you regulate better, because the more you regulate, sometimes it stifles innovation. So I think having that clear balance, that what you want here is better regulation. These standards, and I know KDC, a number of DFIs have already been applying this. The reason I put this up is because it can actually help, because if you're talking about a tailor-made framework for DFIs, this is already there, and it has already been there. They have been doing the self-assessment, there's a peer review. This is developed by African Development Finance Institution, AIA DFI, which I believe all the local DFIs are member of. And one of the recommendations actually is that it recommends that DFI should either be externally supervised by a central bank or a financial institution advisory board. So either you ensure that you are under central bank regulated or create your own advisory board that specifically for that DFI. So I think the key for here is that these standards can actually serve as a foundation for our own sector-specific DFI regulator and supervisory framework. So whichever model that we are can form as a very good foundation for us to start as DFI. It covers actually all the areas that we talked about, governance issues in terms of the board effectiveness, independence, the financial standards, capital adequacy, access quality, operational standard, risk management, lending policy. So it's very comprehensive and can really form a very good foundation. On what is now proposed to, and I know the DG mentioned that about the draft that is already there, but I think key for us is to, I think, for members who are here then to see what are, I think, get that input. And this is what then is proposed to be covered in the DFI bill. In terms of the definition of classification, so here you are saying that we need to define the DFIs. Actually, who falls under DFI? Is KMRC, for instance, a DFI or not? So we need to distinguish that so that we are sure that these are the DFIs, and of course also separate that from other commercial entities. This is where we'll establish governance standards, provide it, reporting obligation, under the. So we look at the categories of DFIs, what are the permissible activities, the development mandates. So under the prudential regulation and supervision here, these are the standards we're talking about in terms of the capital adequacy, liquidity requirements, the governance obligations, and the governance and fit and proper standards. This, we are talking about the issue of board independence, conflict of interest, how do you manage that, performance accountability, and of course ethical governance. So a bit of it is already entrenched in the GOE Act, but we'll see then how we're able to replicate here. On development impact reporting and ESG, I think also Leah mentioned on that, we need to, the DFI should be required to report on either the SME impact, the climate financing, job creation, regional inclusion, and of course ESG performance, and the recovery and resolution framework. This is where also we have struggled most DFIs because of the legacy issue. And here we are looking at early intervention, the restructuring, the recovery planning, the orderly resolution, the write-offs. So this should be taken care of, and funding and recapitalization mechanism. How do we bond issuance? Because I think what you're looking at, how do we raise funds from other markets, sovereign support structure, blended finance framework, access to international funding. So that will be captured under the funding capitalization. But also importantly, it's expected that it will provide for transition, a period to actually allow, for example, on the prudential standards, a number of DFIs might need to need a bit of time to actually be able to meet some of those requirements. So then the expectation is that the bill will also provide for a transition period so that the operations are not disrupted. This is just a proposed roadmap. It just mirror any legislative process before you develop a bill to a law. So basically, the starting point is normally to do a policy and a diagnostic review. Here you are just assessing what are the gaps existing in the existing legal framework. And here you're looking at what are the gaps you're trying to address. Is that there is no law? We benchmark. I think we already looked at what other DFI models are out there. What are the ADFI guidelines providing for? And of course, align that with other government development priority areas and see where are the gaps that we need to address. Of course, that should be followed by stakeholder consultation. I think that's what we're even basically doing here. Just engaging all of the affected parties, whether the DFIs, the regulators, the development partners, so that we can develop a common understanding of what are the issues, what do we need to do, and of course, to identify the concern and consensus. That then will help in developing of a policy paper. The understanding is that for any bill, it must be based on a policy. So this policy then will actually then define the objective, the scope of the supervisory model, the governance standards, and the prudential framework. That then will once that is done, it will be presented to the cabinet for approval, which will pave way then for preparing the draft bill. Of course, with the Office of the AG, with the accompanying regulation, basically then translating the policy objective into law, preparing the bill. Of course, there will be a period of validation and public participation. That can be done even before the bill is presented to the National Assembly. After that, then it can be submitted for cabinet before being tabled to Parliament for parliamentary review, debate, and enactment before you go to operationalization and transition together with the monitoring and review. So basically, that's a process. I think, again, the other discussion is to members to look at and, of course, agree who are the other stakeholders that need to come in. Obviously, the National Treasury is expected to help us in taking lead in this. Of course, the other DFIs coming in. There are also other stakeholders like the Office of the AG. The timelines are just indicative. Considering most of it, actually, the documentation already exists. I think it was mentioned there's a draft bill. I know there was also a draft policy that had been developed some years back. So I think then today's discussion, we can agree then how do we move in terms of perhaps even creating a team that will actually spearhead this process. In summary, I think, again, to summarize that for this process to succeed, one, I think the stakeholder buy-in and interagency coordination, that's why I think we are here to start off by ensuring that we take on board all the relevant stakeholders, that we are together in this. Clear distinction between DFIs. I think we talked about the differentiated framework. I think that's very key, that we want to, whatever model that we choose, it needs to be differentiated from commercial banking sector, which then, of course, preserve our development mandate. Of course, the alignment with the government priority areas and international best practice is very important, and the aspect of transition. I think the conclusion is that this regulatory framework for DFIs is a strategic necessity for Kenya. I think for DFIs, and we saw some of the DFIs that were there in the 50s, 60s, and 70s, some of them fell off, or they lost their mandate because they were not able to evolve. So I think the challenge for all of us seated here is that if the DFIs are to move to the next level, as we talk about taking Kenya to the Singapore journey, I think that's where this regulation is necessary. And it is urgent. And it will help in actually strengthening not just regulation about rules and do's and don'ts, but it's about how do we strengthen our DFIs to ensure long-term sustainability. Thank you very much.
So ladies and gentlemen, that was a brief presentation on the rationale for regulating of DFIs. I think we've had a good session from morning. We had from the DG who set the context for the conversation. We heard from our partners, we heard from the World Bank, we also heard from experts, Honorable Nderi, to give his perspectives. And now, ladies and gentlemen, to make this process more meaningful and successful, it is important that we now hear from our guests who are in the room, who are also our stakeholders who are critical to this process. And so then now would like to open the floor for any comments and feedback and your reactions. We have one.
Good morning, everyone. This is an exceptionally great step. Regulation, by all means, protects markets. Regulation enhances investor confidence. In fact, it does exactly what has been highlighted here. Now, I just wanted to mention a few things that potentially will help you to see the journey we took at KMRC. My name is Oltetia. I'm the CEO of KMRC. From the beginning, to ensure that KMRC is a regulated entity. And that is because we thought that we needed that investor confidence. We set up from the beginning with a view that to ensure sustainability of the financial institution, or KMRC for that matter, we needed to mobilize local currency funds in the capital markets. And that investor confidence is so essential. And by the way, my background is regulation. So I've been a regulator, capital markets for over 20 years. Then I went to the National Treasury, worked there as an advisor on financial sector regulation as well. And that's the time I took, which was one of actually my roles to develop KMRC. And that's how we came in today. So number one, we need to identify immediately the regulation that we want. So do we want a mixed regulation, for example, like what he's talking about? The fact that you may need an independent regulator, or in fact use an existing regulator. The focus, I think, over the last few years is not to create a few more regulators. That it's important to identify regulators that currently exist and potentially open the scope of their regulation for purposes of regulating additional institutions. And that's how KMRC is regulated by Central Bank. We identified at that time KMRC to be regulated by either Central Bank or the CMA. The CMA is a securities regulator, which is where I worked before, which tends to focus more on capital markets regulation. Now, the Central Bank is on the financial side, which is mainly on lenders. What the DFIs do is actually lending, which is pretty much aligned to a larger extent with what the Central Bank, the nature of regulation by the Central Bank. But it is differentiated regulation. So we developed a framework, a regulation specifically for mortgage finance companies, and we worked with the Central Bank for that. At that time, of course, I was working with the National Treasury. And so it's completely different from what commercial banks. Of course, there was a little bit of a challenge because the Central Bank will only identify a set of regulations that are pretty much what commercial banks do. And that we had a lot of pushback at that time, but we managed to resolve it. And now there's a regulation called Mortgage Finance Companies Regulations, which is where KMRC is regulated. But of course, there is the anchoring law, which is the Central Bank Act, not the Banking Act, because the Banking Act is very specific to commercial enterprises. In fact, the initial thought was for us to amend the Banking Act. But there was one definition that was almost impractical, called financial institution, which is defined all over, it's actually repeated all over that act. And therefore, changing it was almost an overhaul of the Banking Act, and therefore that's why we went into amending this, I think Section 58 or something of the Central Bank Act to anchor the regulation of mortgage finance companies. Now, that actually gave us the impetus of what we did now in KMRC over the last few years. 2 years down the line, we went to the capital markets in 2022 to issue our first bond. We didn't have a track record. We didn't actually even need a guarantee or a credit enhancement for that matter. We thought we needed, so we had a discussion with IFC and the World Bank, but the investors were confident. And that is because of the nature of the regulation that we had as an institution and even the shareholders or the institutions that are backing up KMRC. This year, we've just gone to the market to issue our green bond. We call it a sustainability bond, which I think you have all seen. And that is the development role that we have. So in my view, it's something that we need to do, and we need to do it fast, because that actually gives DFIs, the kind of confidence that they need. It protects public resources, because of course prudential regulation will mean that there will be prudential guidelines, requirements that we have to comply, risk management frameworks, governance. I think all that has been highlighted here, that will all have to be strengthened.
Maybe. So it's important that you do not leave one of the questions, the presentations. How many DFIs are we speaking? This is the reason should be quite.
Do we have any more feedback? We have one more here.
Thank you very much. My name is Christopher Kiburu from Agricultural Finance Corporation. And I think I am very happy today because of this bill we have. Number one, regulating DFIs will bring about efficiency. But I want to echo what Chairman Rito said, that we must be very careful not to align to commercial banks. When you look at commercial banks, number one, they have what we call shareholders' expectations, and also there's what we call regulators' expectations, and therefore their capital investment can only be to specific projects that have got returns that can be identified. So if returns are not certain, then they are not going to invest in that particular area. On the other hand, DFIs will take risk on projects that even the returns are not certain. For example, climate resilient projects. These are projects that are not certain, and you see every kind of funding is looking into the area of how do we address the issue of climate adverse changes and water mitigations. So I think this bill comes to a crucial time when all these issues of climate-friendly financing come in. Number two, I would also propose that since we have several DFIs that are really affected by this bill, if the specifics could be shared with the specific DFIs to have their input, then I think it could be even more efficient and effective. Thank you.
Thank you. My name is Angela Muga from East Africa Development Bank. Regarding the discussions around the regulations on the DFI, I support because it has been very clear in terms of the benefits that will come from the DFI regulation. However, within the commercial space, you find that the regulation is very strict. There are even penalties on the commercial space. So it's just to encourage that as we think about regulation of the DFIs, let's ensure that we give the DFIs the flexibility so that they'll be in a position to be able to bring out the catalytic development that is required. So let the there not be the extreme penalties that are there in the commercial space. So that flexibility will be encouraged. Thank you.
Thank you, Angela, for sharing your perspectives. So do we have any comments in the room? Okay, so thank you. I think then we can close that session for receiving feedback. And as we wind this down, from when we started in the morning, I think it's become very clear that the time for regulating DFIs in Kenya is now. The need has been identified very strongly. And we're now going to continue this conversation. This session was just an open brainstorming session, so that we can now agree then moving forward, how then do we progress this so that we can get the legislation that we want to, the regulatory framework that we're looking for. So DG Kibet, under your leadership, we would be requesting that you support us to form a technical committee that comprises of membership from the various participants that we have seen here. We have seen very valuable contributions from partners like KRMC, who have done it and have done it successfully. We require also support from the Office of the Attorney General, but mostly we would like for this process to get the importance that it deserves. So we'll be requesting your leadership to be able to help us to move forward. Now, in John's presentation, he highlighted the process that is required to be followed in order for a bill to become law in Kenya. But from what feedback we have received in the room is that perhaps we may not need to go to the level of a law. Perhaps we just need to develop regulations and subscribe ourselves under the Central Bank Act. So those are the conversations that the technical team will undertake and then come up with recommendations, and then we can then convene another stakeholder validation session, and then now we can move this forward. So with those remarks, I think Chairman and DG, and then we would like to now close the session, unless you have some remarks you want to make. Yeah.
Thank you very much. I'm just asking this as a participant, not as chair of KDC. In thinking about how to make these DFIs agile, big enough, broad enough, is there room, and is there any maybe practical examples where we can begin to think in terms of diluting the public sector capital, the government shareholding? If you take us KDC, when a DG, each time we have an AGM, we have one shareholder sitting there with us and the rest of us. Is there any room to sort of dilute this capital by bringing in perhaps other players with a global perspective, even external ones, to team up with, say, our DFI like KDC? So it's also owned both by government and by any other of these, because that by itself also introduces a certain discipline or requirement for, a level of discipline. As we think about the regulatory framework, we can kind of say, even within our own shareholding, we have to meet the following rigors of compliance, of whatever that might be. I'm just thinking aloud. I think it is in Turkey that I saw an example, but I couldn't get the specific details. I think it is one way in which we can increase the basket. And then as we think about, and so the regulatory framework would then be influenced by the fact that it's not owned solely by the Kenyan taxpayer, but it's also owned by other shareholders and so on. Thank you.
Chairman, DG Kibet wants to make comments as well.
Thank you, Chairman. I think that is a very important observation. And I think, as we said, we should really not even reinvent the wheel, but see what has worked and also learn from it. And I think now that KMRC is in the room, government shareholding is what now, 13? Yes, but government of Kenya is about 25%.
and the others, private sector players, mainly commercial banks and SACCOs? Yes, correct. So I think that's a good idea. So I think that would be a place to look at, figure out how you can get invitations to people like Propaco who are in the room, AFC, IFC and the rest. I think that would be very progressive. It's something that we should think about. Thank you.
We have a comment from Leah behind you, DG.
Maybe just to add to the good comments by DG, the beauty of Kenya is you have precedents. I think Kemar says first, the DG is leading the credit guarantee scheme and our project that also has a similar structure where the government is going in as a minority shareholder. Now, Chair, you raise a good point, and of course, most of the time the issue is the political class don't want to cede control from DFIs, but I think what we've seen from other markets in South Africa, we have an existing project where we're introducing private sector players through convertible debt. So that could be an easier way to have this conversation. You start off with debt that eventually, ideally, converts into equity shares, and that might be a bit more palatable. And I know Propaco here as well would be quite interested. The IFC from our end would also be interested in those kind of arrangements. Now, of course, it's a phased approach. You have to start where you're starting today. The DFI bill has to give the markets enough confidence that ideally they can take up that level of risk on your balance sheet.
Thank you. I was about to say to Leah, because the Honorable Bunyasi and I did come from politics, we can speak perhaps on behalf of politicians that we are happy to cede some control, but I think I agree with DG Kibet and the chairman that inviting private capital, for example, into KDC or KIE, AFC, would be a really timely move, and it does many things to assist to capitalize, to assist to mobilize more resources, also to manage the governance questions. My second comment, as we think about this regulation, I know for a fact that the subnationals, so county governments, usually in their regional blocks, Pwani, Lake Basin, have toyed with the ideas of can they have DFIs, and I think it's something that we should consider because that is, after all, the governance architecture of Kenya. That if a regional economic bloc wanted to do a development bank of some kind, can it be accommodated in these regulations? Thank you.
Very good feedback from the floor. I think from this session, so we'll have a working paper so that all the contributions, all the perspective insights that we have received in this room today will be put in that paper, and then we'll inform some of the terms of reference and the scope for the technical committee to consider as they seek to develop a report and recommendations on the way forward for regulation of DFIs. So ladies and gentlemen, without taking much more of your time, I'd now like to invite the Director of Corporate Services, Kenya Development Corporation, Kennedy Wanderi, to give our vote of thanks. And then we'll have a brief session for photos, so please stay back for that, and then we can release you to go on your day's business.
Chief guest, Director General of Public Investments and Portfolio Management, Lawrence Kibet, representing the Cabinet Secretary to National Treasury, Honorable Derito Murray, Chair of KRA, our Board Chair, Honorable Dr. Sakwa Bunyasi, our Director General, Nora Ratemo, Board Member KDC, Dr. Faith Mwaura, the CEOs present here, CEO of AFC, KRI, and KIE, partners, and other distinguished guests, ladies and gentlemen, good morning. On behalf of the Development Development Corporation, I wish to express our sincere appreciation to all of you for taking time to join us for this important engagement on the regulation of development finance institutions. Allow me to convey our special gratitude to our chief guest, Honorable Lawrence Kibet, representing the Cabinet Secretary, for honoring us with your presence and for your insightful keynote address. Your remarks reaffirmed the critical role that DFIs play in mobilizing long-term capital, supporting strategic sectors of the economy, and advancing Kenya's development aspirations. I wish to thank the CEOs of our development finance institutions, and all stakeholders present for your valuable contributions in today's discussion. The quality of the dialogue and perspectives shared demonstrate the collective commitment to strengthening Kenya's development finance ecosystem and ensuring that our institutions are equipped to play an impactful role in the development of our country. We are particularly grateful for the constructive feedback and recommendations provided on the proposed regulatory framework. The insights shared today will be instrumental in refining the policy and legislative proposals in shaping a practical roadmap for Kenya's economic development. As we live here today, we do so with a stronger sense of shared purpose and a renewed commitment to working together to advance this important reform agenda. KDC remains committed to engaging all stakeholders as we move towards the next phase of consultations and legislative development. With those remarks, I thank you all for your participation, partnership, and continued support. I wish you a productive day ahead and safe travels. Thank you very much. Okay.
So now we have a photo session, so please stay all behind. We all want to be in one photo. So Emily will come and lead us on the photo session.